Wakana nnyo mu kulongoka kw'abaana bali sigala bakugasa wakufuye esinga ebbeeyi baana si bizimbe si mmotoka si mataka abaana ahakugarwa be basinga ekyebbeeyi n'okusinga amataka n'okusinga zaakeedi n'okusinga zikalina n'okusinga buli kyabugagga kyonna ekibaluka.
Well, good evening. How are you, Sarah and Hajar? You can confirm if you can hear me. We start.
Yeah, fine. How are you, Natu?
Okay. It's Katavas, yeah. But so this is the question I'm going to be doing. It's the BCOMs guys did this one as their test one. So someone shared it with me. I thought we can discuss it since it's on group accounts. Okay, so without waste of time, with group accounts, you look out for, okay, so far, look out for two things. Okay, you look out for the fact that there's a subsidiary, right? That a particular company is trying to acquire shares in another. So whichever company is trying to buy shares in another company qualifies to be a parent. Okay, that's only on a condition that you have a subsidiary and an associate. When you have any of those, you have what you call a group. Okay, so whoever is buying, whichever company is trying to invest in another, that's what they call a parent company. Okay, but there are conditions for you to meet that. Okay, for us to have a subsidiary and an associate. So we say that we have an associate if the percentage that you're trying to acquire or the extent to which you're trying to influence a particular entity or company by buying shares in it is significant. Okay, an associate, we talk about what you call significant influence. Okay, and the indicators of significant influence, and we shall see those. Okay, but the main one that stands out that we normally use when you're trying to attempt an accounting question is where you have a percentage that is 20 and above. Okay, and also it shouldn't exceed 50. Okay, if you're between 50 and 20, then you're saying you have an associate. Okay, then we flip the other side. We have a subsidiary. Okay, we say a parent and a subsidiary exist on the condition that the parent, the one who is buying, the company that is buying shares in another, has more than 50%. Okay, more than 50%. If you have more than 50%, then you're saying you are an associate. I mean, sorry, subsidiary, right? And the reason is because of the fact that we attach the percentage to the issue of control. Okay, we say there's a subsidiary and a parent, there's an element of control. And indicators of control, one, I've just said it, where you look at the percentage of shares that a particular company has in another. Okay, if it exceeds 50%, then a subsidiary. Okay. So having said that, my emphasis will be mainly on a subsidiary because at least that's what they normally said. That's where they can bring a 20-mark question. because for an associate, it can be more than 20 max. Okay, the maximum you can get is about 5 or 3. So they either bring a subsidiary or they bring both a subsidiary and an associate. Okay, so the question given here, or the one that I've shared, you're going to see how you can go about it. But part B and part C of the question, if I may just share with you that. Okay, a moment as I. Okay, from my scroll to the required bit, the required wants you to prepare a consolidated statement of financial position, and then also wants you to define a parent company. What's a parent company? So by definition, we're saying that the parent company is one that has either control or significant influence in another company. That is what we call a control, that you have a subsidiary and an associate the other side, either of the two or even both. Then the one that has control or significant influence is what we call a parent. Okay. Then part C is with reference to appropriate accounting standards, distinguish between a subsidiary and an associate. Okay, I've just said it briefly. We're saying that with a subsidiary we have control. Yeah, the parent has control in subsidiary, and the indicators, as I think the last part they're going to ask. Okay. Then for associate, as long as there's what we call significant influence, that the parent has significant influence in a particular company, then the other company is what we call an associate. Okay. Then part D says that suggests the 3 elements of control as identified by FRS 10. In other words, identify factors or conditions that show that we have control or we have a subsidiary. Okay, and one of those, like I said, you must have at least more than 50% of shares. Okay, and they're not just shares, but voting shares, what you call ordinary share, the ones that allow you voting rights. Okay, guys, we are 3rd years. Let's respect ourselves. When you join, kindly mute. Yeah, please. I was talking about the control thing. Yeah. So what are the indicators? They're saying one of those is the percentage. Okay, and it must be about really voting rights. Okay, not just any shares. You can have preference shares. Those will not get you what control. Okay, what you need is ordinary shares. Then the other element you can look at is if you have representation on the board. Okay, and not just representation. You should be having at least 50%, yeah, of members on the board, so that you really show that you have control in terms of when it comes to making decisions. And because you have a bigger chunk of people representing on the board, the decision is likely to be influenced or controlled by you. Okay. Then the other element, what will be the element? Okay, I will need to remind myself. Okay? In case I remember, I will just share with you. Okay, but basically those are some, I think like 5 under control. Okay, so I'm not going to discuss theory because I believe you guys will read it. Okay, I think it's among the first pages of the handout. Okay, they're clearly written and easy to understand. So let me go to the question, which you're supposed to at least attempt. Yeah, preparing consolidated statement of financial position. And this one should be, it's always the easiest, because they bring for you to consolidate profit or loss statement. It's a bit tricky, although it can also be easy. Yeah, but the easiest is financial position. What's significant influence? Okay, significant influence, we're saying you don't have control, but again, you can influence some decisions. Okay, and a true indicator of that is when you have between 20% and 50% of shares in a particular company. Okay, you can easily influence because you have they're not majority shares, but at least you can be considered there. So that's what we call significant influence. That you can influence some decisions. Okay, you may not really make the decision, but you can easily lobby and influence a particular decision to go to your side. Right, but of course, for accounting purposes, there are indicators. The main thing that really stands out is the percentages. Okay, the ones that we use here when you're computing this. That once you see a particular percentage, then you can easily make a decision and know whether it's a subsidiary or an associate, and therefore accordingly account for it as you should, because they're accounted for differently. So let's go and attempt this question. So given a balance sheet, or statement of financial position, and as you're aware, we deal with additional information first, do step 1, and follow those steps clearly, and then see what you come up with. Okay. I don't know what's on WhatsApp, but just kindly bear with me as I respond to a few chats on WhatsApp. Okay, okay. So if I may share my worksheet. Okay, here it is. Workings, we're trying to consolidate, yeah. Workings. And I have my statement of financial position here. Consolidated. Kindly mute. Please mute. Okay, so we're saying our working number 1 is usually the group structure. This is where I think consolidated becomes a bit easier than IS1, because this one has steps. You just follow the steps. Chances are high that you will do the right thing. Yeah, even with a little understanding. But of course, the understanding gives you an advantage, but that doesn't matter really. Yeah. So group structure. With the group structure here, you're trying to establish what's the parent, what is the subsidiary or associate. Okay. So how do we establish that? Usually we use percentages, like I already said. So we come and confirm if we're given a percentage. If you're, when you check the when you got the question, okay, kindly confirm that you can see the question. Yeah, they will tell you how you determine whether there was a control and stuff like that. Is you just look at the shares. If you're not given a percentage, you look at the shares that you acquired as the parent, and then you look at the shares that were issued or that are present in a subsidiary. Then if what you acquired is in terms of percentages, if it's more than 50%, then you have subsidiary. So this is how we determine the percentage. Okay, it wasn't given here, so we're supposed to define it or determine it. Okay, and the formula is clear. I've just said it in words, but we're saying you just get the number of shares acquired by the parent. Okay, in this case it was H, but it doesn't matter. Then divide by the number of shares issued by a subsidiary, or in this case by the other company, because you don't know that's a subsidiary or not. Okay, by the other entity. So this must be expressed as a percentage. Hence, multiply that by 100%. Okay, so let's confirm how many shares we acquired and how many were issued, then move on. Okay, so usually the ones that are issued are usually given in the balance sheet. Okay, these ones here, they're usually in the statement of financial position. okay, of the subsidiary. Okay, whereas these ones are usually in a statement, they tell you clearly, or if not here, they also appear in the balance sheet of the parent. Sometimes. Okay. Okay, sometimes. So whenever you have met those questions where they don't give you, they don't say that the parent acquired 10,000 shares in a subsidiary. They don't tell you. Okay. So usually it's hidden in the what? In the balance sheet. Actually, not even hidden. Just go under current assets of the parent, investment in the subsidiary. The shares will always be given there. Yeah. But in this case, it was given in writing, so you can read what they actually acquired. So when we read, they're saying that H acquired 6 million of SE's ordinary shares on 1st April 2014. Yeah, you're interested in the shares that acquired, so don't think too much. Just go and put the shares there. They're 6 million. So if I go to my worksheet again, I'll say the shares that were acquired were 6 million. Okay, so you're done. These were acquired. Yeah. Then you now go to the next task, which is determining how many shares you actually issued by the subsidiary or the S, the company they bought. So you can still refer to it and see. Okay, so here they're saying, so as you can see, or if you read the text, you won't find any solid information. Let me zoom. Okay, that's the text. So it's nothing like shares for the subsidiary. However, like I said, they're given always in the balance sheet. Yeah, statement of financial position. You have ordinary shares, one shilling each. Okay. They didn't give you the number of shares, but they gave you the price of a single share. And then when you look at the value of capital of ordinary shares, it is 8 million. Yeah. So 8 million shillings. So how you determine the number of shares? You just get the value, which is the 8 million shillings, and you divide by the price of a single share, which is given as 1 shilling each. So if I may take you to the worksheet again. Okay, we're saying that ordinary shares in S are valued at 8 million. Okay, and this is in shillings, yeah. This is shillings. Then you ask yourself, what's the price of a single share? Okay. Price of share is 1. Okay, say 1 shilling. So the number of shares therefore will be equal to the price, or the value of shares divided by the price per share. That's how we end up having still 8,000. So it's 8,000 divided by 1 shilling, giving you 8,000 shares. So you bring here 8,000 shares. Then times %. Okay, so our answer will be this divided by that times 100%. Okay, so you get 75%. So, and we said for a subsidiary, once it's more than 50%, then you have a subsidiary. Yeah. So our group therefore will be reflected this way. You have H, then you have S. Yeah. So it's important to bring about the acquisition date. It was 1st April, I think 2004. I'll just confirm. Then you're saying you have 50% or 75%, sorry, 75% control. So by doing that, you're good to go with the question. It was bought on. It's 1st April 2014. So that is step 1. Yeah, group structure. You identify the percentage. If it is given, well and good. You don't have to do all this. Just put it there. Either 50% or 75, whatever is given, put it. Yeah. But otherwise, that is it for step 1. Then you go step 2. Yeah. For those who like reading the whole question before you attempt, I don't know how you finish such a question. Yeah. Otherwise, you're supposed to be knowing what you're looking for. So step 2 says you look at the net asset summary of a subsidiary, in this case of S. Yeah. For net asset summary, you're looking at details. Okay. Then you're looking at the acquisition date. Then you're looking at the reporting date. Then most important is the movement. So this is your summary. Okay, nothing to think about really. Put it there. Yeah. So once you're done here, by net assets. Okay, guys, please mute. You're distracting me. I was saying the net assets. Remember from our accounting equation. Okay, from our accounting equation, we say that when you have total assets and deduct total liabilities, the liabilities, what you have is what we call net assets. Okay, which is the same as actually equity, okay, or what you call capital. So in short, because a subsidiary has very many assets, you have non-current assets, you have current assets, okay, very many of those. Then for liabilities, you have also very many of those, long-term and short-term. So because of that, you can't bring all that information on such a small working like this. Yeah. So what we do is we use the equity component or the capital component, where you look at their ordinary shares, if there are any reserves, if there's retained earnings. So that you have a summary, a short summary, yet meaning the same thing. Okay. So that's the reason why we bring those. So here you have ordinary shares. Actually, don't even start straight away. What you do is you go to the balance sheet, okay, statement of financial position. You go under equity. Yeah, you have equity and liabilities, and you have equity. Items under equity is what you bring. You have ordinary shares, you have reserves, you have share premium, you have retained earnings. Yeah, those are what you bring in your working. Okay, so I don't want to come back this side. So allow me pass the information without you saying, then you see later. Yeah. So we're saying you have ordinary shares. You're seeing the figure there, ordinary shares. So what you have here in the balance sheet is reporting balances. Yeah, they have reporting balances. So you take the reporting balance. It's 8,000. Take them to the reporting column. Yeah. Okay, I'm ignoring the zeros. Then the other thing you have are the reserves. Then you have share premium. Then you have retained earnings. And I'm saying what you have in the balance sheet are reporting balances. Okay, so we have 2,000 for, okay, I think there's nothing for reserves. You have 2,000 for share premium. Then you have 6,000 for retained earnings. Okay, for retained earnings, they gave you the opening and closing balance. So just take the closing, which is the last one, which is 8,000. Okay, so if I may share the worksheet now. Okay, this is the worksheet. Okay, we're saying, okay, this was just a working explanation. We're saying you go under equity and bring all those items: ordinary shares, reserves, share premium, retained earnings. Then whatever is in the balance sheet, we are saying those are reporting balances. Okay, bring them the way they are. You have 8,000 for ordinary shares. You have share premium 2,000. Then retained earnings. Retained earnings, they gave you two values. If you are keen, I can maybe take you again and show you. Okay, here they said retained earnings. You have at 1st October 2013, and then for the year 30th September 2014. Yeah. Actually, this is profit for the year, not the closing balance. So you're supposed to add the 6,000 plus the 8,000. I hope we're together on that one. Okay. They give you retained earnings at the start of the year. Okay. Let me just take you to the end of the year. What does it say? The year ends on 30th September 2014. So meaning they must have begun on 1st October 2013. Okay. And then they're telling us in the balance sheet that for retained earnings, you have a balance at 1st October 2013, the opening balance, 6,000. Then you have what happened during the year, what they're saying for the year, meaning that the profit for the year, yeah, was 8,000. So for us to get retained earnings at the end of the year must be what we had at the beginning plus what we have for the year. 6 plus 8 is 14. Okay, not 8 like I put. So let me go and adjust accordingly. So it is 14. I hope we have all seen the 14. Okay, so these are the balances at the end. Yeah. So going back to the question, we now want to know now what was at the beginning of the year, right? So if you go there, they're saying that H acquired 6 million of SC's ordinary shares on 1st April 2014 for an agreed consideration of 24.85 million. Okay, that's the consideration. We're not interested right now. Then they're saying that the consideration was settled by a share exchange of 5 new shares in H for every 3 shares acquired in S, and a cash payment of 4.8 million. Yeah. So our consideration, okay, we shall look at it. It's the next step. So it's not important for us. What we're interested in right now is the retained earnings at the beginning of the year, ordinary share at the beginning of the year, share premium at the beginning of the year. Not at the beginning of the year, but at the acquisition date. Yeah. So a given cash transaction has been recorded. We don't mind. Then they're saying that the draft statement of financial position for the two companies is as follows. Yeah, this is the draft. Okay, we don't mind, we don't mind. Yeah. Our interest is what do we have at the point of acquisition. So there's more information here. Okay, so let me have to unzoom. So the additional information says that the fair value of S's land at the date of acquisition was 4 million in excess of its carrying value. That is land. Okay, for those who have read out some numbers, you're aware that this working here, the net asset summary. Yeah, it has what you call fair value adjustments. Okay, these adjustments come in because first of all, we're using equity shares. Here we're using equity. So if there's anything like revaluation in land or in liabilities, it may not be reflected here. So what we bring here is, this one here represents the book values, yeah? The book value of the asset at the point of acquisition. So if there's any increase in the book values, we must reflect them even here. So we shall bring, okay. So we shall bring our land and say land, yeah? It was in excess. Okay, the specifics in excess. It's on acquisition date, not reporting date, yeah? So it is 4,000. You bring it here, that item. Then we go on reading and see what they're saying still. Okay, you're interested in information at the reporting date, at the acquisition date. No, I'm saying reporting. Then SS financial statements contain a note of the contingent asset for an insurance claim of 800,000 relating to some inventory that was damaged by a flood on 5th March 2014. Yeah, financial statements reflect. Yeah, then they're saying that the insurance company is disputing the claim. H has taken legal advice on the claim and believes that it is highly likely that the insurance company will settle it in full in the near future. Yeah. So the fair value of S's other net assets approximated their carrying amount. Okay, that's the acquisition. Now, there's this item insurance, the 800,000. This is okay. I won't cover this standard yet. It is IS 37 provisions and the contingencies, something like that. I shall look at it, I'm sure, with Madam this week. Yeah. So what we do with this figure is, whenever it is highly likely, okay, the chances are 100%, that's highly probable, then we record the amount. Okay. So this one was regarding an inventory and it's a contingent asset. So meaning that you have a claim. So your assets must be increased by the 800,000. So you reflect that in your books. Where have you added on the retained earnings? Okay. So just take you back to my worksheet. Okay, yes, let me first put this contingent asset. Contingent asset, it was 800,000. Yeah. Why have I added retained earnings? Retained earnings, the information is what is making me to add. Let me show you the information again. Remember, we're interested in the retaining earnings at the reporting date, okay, the closing balance. That's what they're saying. They're saying that in your balance sheet, what you call statement of financial position, okay, here, they're saying that retained earnings, okay, retained earnings, they're saying that at 1st October 2013, and I'm saying this is the start of the year, the starting date of the year, it was 600,000. Sorry, 6,000. Then they say that for the year to 30th September 2014, meaning from 1st October to 30th September 2014, what they made as retained earnings or as profits or as earnings were 8,000. So meaning that our retained earnings at the end of the year or on 30th September 2014 is not just 8,000. It's not just the 8,000, but rather what you had at the beginning, then plus the new profit that you have, giving us the 14. Okay, so I hope I've answered you. So back to our additional information. So for fair value, we're supposed to do that, yeah. Then our interest is still on retained earnings. What did we have when we acquired it? Yeah. Okay, they're not saying anything else anymore. And okay. We're looking for information regarding retained earnings at the beginning or the acquisition date. Its group's policies to value the non-current asset, non-controlling interest at fair value of 10. Acquisition date. Okay, I don't think I have retained earnings at the start. Let me first look up again. Okay, I'm looking at the balances at the start of the year. The acquisition happened on 1st April 2014, not 1st October 2013. Okay, it happened here. They're not giving us anything to do with retained earnings at this date. So what do you do? What you do is this. Let me spell something saying that I was kindly put on me on the reason. So I have considered land and You don't consider the land, you consider the excess, the difference. Okay. The reason is that the net assets summary shows fair value of the net assets at acquisition date. Fair value of the assets at acquisition date. So when you have book values reflected in the net assets, let me explain as I show that. Okay, we're saying this table here, yeah, it shows reporting date and acquisition date. But to be specific, this shows the fair value of net assets acquired at acquisition date. So whatever you have for ordinary shares, reserve, share premium, and earnings, these are book values. So whenever there's a change in the fair value of the book values, either they're increasing or reducing, it must be reflected or it must be added so that you have the fair value of the total assets. Okay, so why am I adding for land here? We are saying what you're bringing here is not the fair value of the land, but the excess or the difference in the land. That you had a book value of 10,000, for example, and they're saying that the fair value is 14,000. So the excess, that 4,000 is what you're looking at. So let me just take you there shortly. On the note, they're saying that guys also joining. Please mute. You're really doing me a disservice. Alicia, please, you mute. Stella. Okay. Maria, here you're saying that the fair value of the land at the date of acquisition was 4 million in excess of its carrying amount. And I'm saying figures in the balance sheet reflect the carrying amounts. So for you to adjust that to get the fair value, the real fair value of the asset, you must add any excesses that you acquired in the middle. If there was a decrease in fair value, for example, then you subtract. In this case, I'm saying excess, meaning that it increased, so you add. That's why you're putting this 4M under those others, you're adding it there, so that the book value reflects the actual fair value of the net assets. Maria, I hope I've answered you on that. Now, going back to retained earnings. The acquisition date, remember, is first April. Yeah. Acquisition date is 1st April 2014. What we have as retained earnings. Retained earnings. The information that we have at least. We have the one at 1st October 2013, okay, which was given as 6,000. Then we have the profit for the year. As 8,000. So for us to get the retained earnings at the acquisition date, this 1st April 2014, we're supposed to come and make some few assumptions on this profit. One, that this profit is occurring evenly during the year and the first 12 months. That is for sure. Yeah, because for the year. So we ask ourselves, how many months are between the acquisition, the starting date, which was 1st October, and the acquisition date, which is 1st April. Okay, now this link is going to shut down in a short, so I think I'll start from there. Kindly join in as soon as the link closes. The same link, just join again the same link. Otherwise, maybe I can respond to the chat. Okay. Okay, so I don't want to say really much more about the retained earnings right now because the link is closing in a few. So let's join again in a few minutes. You're joining with the same link. Join with the same link.